What's up, guys? Welcome to this episode of the GrowingAU Show. I want to say right from the start, this episode goes out to Hulk247, who left a comment on one of last week's episode asking for my opinion on investing $800 to $1,000. Now, Hulk, I got some news for you. I have a second video coming for you in a couple weeks. We're going to be going over some strategies of investing about $800 to $1,000. However, the other thing that they asked was, any recommendations on stocks between $5 and $75 for long-term investing? And I want to be giving you some of my opinions on that today, talking about my 5 favorite stocks under $100 coming up. So I just want to really quickly thank you, Hulk247, for the comment. First of all, it's an awesome name. And second of all, I hope this video is useful to you. Anyone else that wants some awesome information provided to them, drop us a comment down below and we'll get back to you in the comment section, or maybe even get a whole video sponsored to you like this one. So let's jump into it here. The hard part when it comes to investing $800 to $1,000 is the fact that a lot of assets that people talk about are very expensive. So it comes down to it, you may be able to buy, like, let's say 4 stocks at $250 and then that's it, you're gone. And for a lot of us, we want to be doing a little bit more than that with our money. I know when I first started investing, I only had $2,000 to put into the market. And let's be honest here, for those of you that invested for a while, you know that $2,000 is not much more compared to $1,000 with the amount that you can buy. Now, some of you may choose to go and buy penny stocks and things of that nature, and there's a whole nother list of dangers and risks there as well. But we're going to be talking about 5 stocks today between $5 and $100 that you can start investing in right now that I think will have some pretty decent returns into the future. Most of these stocks I do personally own myself, and I will let you know any of the stocks that I don't own, but for the most part, you can just consider all the assets in this video I do personally own. Investing $800 to $1,000 might be hard. I know there's not a whole lot of videos on it on YouTube, but I do want to say right now that I do think it is possible to do it well. So with that being said, let's jump into the first asset, Zynga. Now, for those of you that don't know a lot about Zynga, I talked about them in this video here, the 5 best stocks under $50 picked by the Motley Fool. But for those of you that are joining us first time with Zynga, let's talk a little bit about them. So first of all, Zynga's share price right now is $9.12. When I made the Motley Fool video about, I think it was like 6 weeks ago now, they were at about $7 a share. So they have risen dramatically since that point. Speaking of dramatically, let's look at this graph right here, up 198% over the last 5 years with a 76% buy rating for the investors and experts over at Morningstar.com. Some recent news about Zynga, and just for those of you that don't know, they are a mobile game app developer, developing a lot of gaming apps for your phone, many of which you may have heard of. And if you think, I haven't used any of Zynga's games before, well, actually, you have. See, Zynga has recently partnered with Snapchat to develop all those Snapchat games that you can use on their platform, and Zynga has a big hand in that. So major deal there with Zynga and Snapchat. The reason for this increase in the value of Zynga is because of a $1.8 billion acquisition of the Turkish company Peak Games. The two companies merged, Zynga acquiring them, and this has caused a lot of people to be very excited about Zynga. After all, it took their stock from $7 a share up to $9 a share. At one point, I think actually hitting $10 a share or just shy of it. And actually what has happened here is that Lou, the expert from Barclays, actually expects Zynga's stock to raise up to $12 from $9 over the next year. So really some incredible growth potential at Zynga. We've seen them have a really great 5-year growth, a leading company in the mobile gaming industry. And let's be honest, at $9 a share, if you only have $1,000 to invest, you can really increase your position in Zynga. So moving up from there, we're going to go to another asset that is slightly more expensive. This is Eldorado Resorts, coming in at $37.01 per share, up 349% over the last 5 years, and at an 80% buy rating from investors over at Morningstar.com. So what is Eldorado Resorts? Well, Eldorado Resorts is a casino entertainment company. Eldorado Resorts, a major player out in Las Vegas when it comes to casino and resort destinations. They've really had an incredible 5 years, 349% growth. They're up there with other popular stocks like MGM Resorts, Boyd Gaming, Penn National, Wynn Resorts, and things of that nature. But Eldorado Resorts, my personal favorite. I bought them right after the crash at a relatively decent price, and I'm very excited to see how they're going to continue to grow over the next couple years. Yahoo Finance is also with me on that one, saying that Eldorado Resorts is likely a very undervalued stock. If you've heard of the Zacks ranking system, they currently rank Eldorado Resorts as a number 2 as in a buy and a value grade of A. When everything starts to open back up, I think we're going to see people flooding to Las Vegas Vegas, to go back on those vacations, to get back to the casinos and things of that nature, spend that money that's just been accumulating. We know that people like to do that, and I want to be one of the investors that is benefiting as these companies continue to benefit as well. As we've seen, Las Vegas doing kind of a soft open over the last couple weeks, and these stocks have done rather well since that point. Eldorado Resorts currently at $37 a share, up actually in the high 40s at one point, but they of course have come down after that. We've kind of mini market crash we saw last week that was affected by the Fed. But other than that, Eldorado Resorts really doing well since the March crash. Moving up to another stock that I think is worthwhile looking at with only $1,000 to invest, we're going to be talking about Marvell. Now, it's either Marvell or Marvell. Again, we talked about it in this video here, which is actually the 7 best 5G stocks of 2020. Now, I don't necessarily know if Marvell is the best 5G stock of 2020, but when it comes to stocks in that videos under $100, I really think that Marvell is one of the best ones to be looking at. We also have this video here where I go over the best 5G stock of 2020, in my opinion, but I do like Marvell. Currently at $33.72 a share, 139% increase over the last 5 years, and a 78% buy rating from experts over at Morningstar. So Marvell is a company that is going to be really affected by the increase in 5G over the next 5 to 10 years. So Marvell is a chip manufacturing company dealing with things like the Internet of Things, connectivity of machines. They're really doing a lot of kind of back-end development that is going to allow a lot of their products to continue to increase and really kind of increase their usage as 5G continues to grow. Some things that experts are saying about Marvell that they're really liking goes as follows. Marvell has recently acquired the company Cavium, and what experts are saying is that it's really allowing them to continue to compete with other chip manufacturing companies like Broadcom and Intel. Similarly, 5G is a long-term growth driver with infrastructure product demand from several of the firm's core end markets, and data continues to proliferate exponentially, giving the firm's controller business tremendous upside. As I said, there's a lot of different companies we can be investing in when it comes to 5G. I am not claiming that Marvell is the best, but what I do want to say here is I think that they have a lot of potential over the next couple years. If we're only investing $1,000, $33 a share, we can pick up a lot of shares in that company. Coming up next, a company that I not only own stock in, but I'm actually employed by, for all these that don't know, Starbucks. I know that a lot of you financial fire independent people are not going to be spending that kind of money at Starbucks. You're going to be making coffee at home. But despite that, a large portion of the population is spending money at Starbucks. And really, we've seen that with their share price currently at $76.70 a share. We actually have a video right here going deeper into Starbucks. You can go ahead and check that out if you're interested. But Starbucks right now up 47.5% over the last 5 years. They've had continued growth. They are infiltrating Chinese markets as they really continue to expand in China. It's a growing market over there, and they expect really exponential growth in that new market space. Similarly, as you may have heard of recently, Starbucks is actually closing about 400 stores in the United States and opening up more drive-through only models. This is going to bring their overhead costs farther down, and a lot of this is being adapted due to the fact that, as we've seen with the coronavirus outbreak, we have seen a lot of people just kind of going to Starbucks drive-through only, and so this is really leading Starbucks to believe that we don't need to be spending this much money having full cafes open. So they're shutting down about 400 locations and opening up drive-through only stores. Right in line with that, they continue to increase their mobile presence, allowing for mobile orders through their app, making that far easier, along with partnering with companies like Uber Eats to, again, just increase the amount of ways that customers can continue to enjoy their caffeinated products. And then finally, despite some of the things that have happened recently with Starbucks public relations, you may have heard of it, revolving on their Black Lives Matter issues. If not, I do recommend you check it out as an investor because it is affecting the company a little bit. Despite that misstep on the part of Starbucks Corporation, they are a very much so a people over profit company. From someone who works there, believe me when I tell you that they place the customer before honestly everything else. And I think that has, it may hurt Starbucks a little bit at different times, but for the most part, I believe it leads to a really great customer experience, which leads the customer to coming back and continuing to buy their beverages and food items, and which is just going to be great for us investors as the company continues to increase their profit. But right now, very excited about what's happening in Starbucks China. Really excited to see how Starbucks adapts to this kind of new economy coming in the United States after this last pandemic, and as things continue to change. I think Starbucks is a continually growing company that really makes sense to be investing in, and at $76 a share offers a great place for someone only investing $1,000. And finally, my buddy John's going to be happy here. We have Nike. Nike, we've talked about them in this video right here, where you can dive deeper into Nike. Hulk 24/7, we're setting you up, and I really hope this is valuable so far. But we got one more for you. $96.43 a share, grown 90% over the last 5 years, and at a 79% buy rating from investors. Nike, really great asset. This is actually the only asset on this list that I do not personally own. I may actually consider picking up some shares in them in the future. Here's why. So Nike has a great opportunity in fast-growing markets like China. Again, with like Starbucks, our last asset, they realized that there is a lot of growth potential in those emerging markets over there. More than 70% of Nike's growth over the next 5 years actually may come from outside North America. Nike's triple-double strategy has increased innovation and has increased direct-to-consumer sales, which is actually something we need to talk about. So what has happened is that Nike realized that their kind of online e-commerce presence wasn't as strong as it should have been coming into the pandemic. But what that has allowed them to do is realize that we need to make a change, and that now that they've realized there's kind of a kink in the armor, so to speak, they're going to do what they can to fix that, to make sure that the e-commerce presence is much stronger going into the future. The other great part about it is it seems that their customers are loving the e-commerce presence, as membership growth in their digital areas has continued to exceed expectations. And Nike's gross margins may continue to expand a few dozen basis points over the next few years as their automation, e-commerce, and higher prices continue to increase. Nike is actively shifting sales to differentiated retail in North America to increase full-priced sales. Overall, Nike doing a lot to continue to increase itself, and I think at $96.43 a share, definitely the most expensive asset we have on this list, but despite that, I think it's still a very reputable company that you can consider buying when it comes to investing $1,000 into the market. All right, guys, I really hope this was useful to all of you. Hulk 24/7, I hope you enjoyed. As I said, I do have another video coming out for you. It's going to be about 2 to 3 weeks before that video is released. We have a kind of some more production we want to put into it, but you have inspired us here to continue to make awesome content. Thank you. Anyone else that you want anything, comment it down below, and we will see what we can do about making a video on that as well. Tell me what you think about these 5 assets. Do you own any of them? Do you like them? Do you not like them? Let's get a comment going and kind of a discussion board in the comment section to help all the new investors that are looking to invest money in the stock market. With that, keep a cool head on your shoulders. Let's go make some money, and I will catch you next time.